Thanks for joining us, everyone, for our Savvy Ladies Wednesday Wisdom webinar. My name is Maggie Montemuro, and I'm the Marketing Coordinator at Savvy Ladies. If you have questions during this presentation, please type them into the chat window. And if you're joining us by phone, you can email your question to info@savvyladies.org. Today's presenter is Jacqueline Frank, Vice President of Mortgage Lending at Guaranteed Rate, the 8th largest mortgage bank in America. Jacqueline is also a respected business networker and serves as a director consultant for Manhattan BNI, the largest networking organization in the world. We want to thank you for being with us today, Jackie, and I'm going to hand it over to you.
Terrific. Well, thank you, and thank you to Savvy Ladies for inviting me, and to our people who are calling in today, thank you for making the time. My hope is by the end of this session, you'll have a little bit more knowledge and ammunition, if you will, to forge ahead into what has become quite a very competitive, somewhat stressful, and difficult process to, first of all, find the home that you want and get all the way to the closing table. So I know that we have a variety of people on the phone, and everybody has perhaps different goals and what they're looking for, but I'm going to try to focus this in the right middle. I know we have people on the phone from New York, some people across the country, and there are different nuances in the business that have to do with geography, certainly. Just a little bit overview of myself, my history in the mortgage business. I'm going to date myself. I did join the mortgage industry in 1994. And back then, it was a rational business. We asked for some paperwork. We looked at it in a reasonable amount of time. The underwriters were able to make a decision and let you go to the next step of closing on your home and moving in. And it was much less stressful. Along the way, for those of you that were watching, it got a little bit out of hand. It got much too easy for people to borrow money. Lenders got greedy. To be fair, consumers got greedy. Everybody in the chain was very excited about how easy it was to find property, borrow money, and buy and sell at quite a rapid pace. And then the bottom fell out when they realized that the mortgage world was not looking at the paperwork, and many people, thousands of people, got mortgages that they could not pay. And here we are in what people reference as, the pendulum has swung quite the other way, and now it's very onerous to get a mortgage. So my goal here is to walk you through what the process looks like now, get you prepared to begin the process. And when I say prepared, I literally mean that before you even go out with a real estate broker or drive around on a Sunday looking at property you'd like to buy, there's work that you could be doing to get you better suited to do this. So I like to say I've seen the good, the bad, and the ugly, and it's something that consumers need to really know how. So let's start off with the various loan programs that are out there for us. So first-time home buyers, which I'm going to assume is the majority of the people on the call today, have a few programs available. Depending on the state you're in, depending on the property you buy. We have government loans, which are FHA, VA, and USDA loans. Mostly the USDA won't apply to our metropolitan cities. Conventional loans that are fixed and conventional loans that are adjustable. Those are still available if it's the right product for you. Jumbo loans and home renovation loans. And we'll touch on the majority of these, probably not all of them for today's call, but I will focus most probably on the top 4. So let's talk about FHA loans. They have a wonderful place in the market for our first-time home buyers and people who bought property before. It is not a requirement that you are a first-time home buyer to take advantage of the FHA product. The highlights of the FHA product, most notably, is a very small down payment, 3.5% of the purchase price. There is an additional cost per month, and it's called mortgage insurance. And I can certainly talk with you individually about that because it's based on the loan amount, your credit score, and some other items. But it is an additional cost that you will have on your loan every month for the entire length of the loan. You're allowed gifts. You don't have to have any of your own money as long as it's a related person in your life. The credit is much more flexible. If you look at one of the bullet points, it says it could be as low as a 600 credit score. And we'll talk about that later on, what credit scores are all about. No income restrictions. This is not set up for low income. This is available to all purchasers. If you need someone on the loan with you, that's okay with FHA. And it doesn't even have to be someone who's living in the property with you. That's what they mean by non-occupying co-borrowers. This is the key for our New York City people on the call. Single family, multi-unit, condos, but no co-ops. You cannot get an FHA loan on a co-op property. And the condominium, as it says here, needs to be approved with HUD. And we can talk about that a little bit later on. I'm going to cover condo loans. Then we move into what is probably the lion's share of the people on the call, conventional or jumbo loans. These are fixed. These are for single family homes. These are for condos. These are for co-ops. And the loan amount is what determines whether it's conforming or jumbo. And I think in the New York area, it's important to point this out. We have 3 tiers of loan amounts. The first tier is from $0 to $417,000. That is the New York and New Jersey and the local tri-state area and most of the people on the call today. But you can find out what your conforming limits are just by going online, or you can certainly ask me if you're not in New York. Once you borrow over $417,000, you move into the second tier, which we call high balance, but it's also still a conforming loan, meaning most lenders offer them. Fannie Mae and Freddie Mac, who are the biggest insurers, if you will, of loans or purchasers of loans, all lend up to 417 in one tier and up to, as you see there, loans up to 625,000, depending on your county. And the last piece is jumbo. If you're borrowing more than 625,000, interest rates change based on your loan amount. And it's probably more of a question for our financial advisors, why it is that right now the larger loan amounts have lower interest rates. Might be a whole host of things, but it is right now less expensive or lower rate to borrow over 625 than it is to borrow under 417. Okay, so let's move on to what this process looks like. The first thing that I highly recommend, as do every other real estate broker or real estate professional you'll speak to, is to get pre-approved. Now, certainly at my firm, and I think in a lot of other companies out there, there are different types of pre-approvals. Now, the first one is pretty easy. You pick up the phone or you send an email and you speak to a loan officer, someone like me, or someone who works at a big bank like Wells Fargo or Chase, and you verbally run through the numbers. They'll ask you what you earn. They'll ask you how much money you have in the bank. They might even ask if you know what your credit score is. And then we'll use a calculator and we'll do a quick analysis of whether you qualify for a certain loan amount. And you can get a letter that says, congratulations, you've been pre-approved for $200,000 if you find a property for $250,000 and you put down $50,000. And I will tell you that letter is worth not even the paper that it was written on, because that is just an indication of numbers. The second level I would highly suggest is if you really want to get into an offer on a property, is that you provide the documentation to the loan officer that you're talking with. So what does that mean? That means you actually show them your income documents. You show them you let them run your credit, because now the letter that gets written has a bit of weight to it. It means that someone looked at your pay stubs and looked at your W-2s. Now, they didn't do a verification with your employer and actually call up your office and confirm you work there, but they at least have documentation that substantiates what you verbally told them, and the letter will have a little bit more weight to it. And why a pre-approval letter is important these days, and for any of you on the call who've actually started this process and gone out with real estate brokers, or even gone as far as offering a seller, a price on a property. We are being beaten out every day by people who are willing to pay all cash. It's a phenomenon that I still scratch my head about how many people are in the position to be able to just walk in and say, I'm going to buy this home, this apartment, this co-op, this condo without a mortgage. Now, that is, if you can picture yourself as the seller, a very appealing offer because of timing. They don't have to wait the 60 or 90 days it takes to get a mortgage to find out that you as the buyer did or did not get approved. So the closing can take place faster, and they don't have to risk the possibility that you don't get a mortgage. So many sellers are accepting offers from all cash buyers, even if the price they're offering is less than the price you're offering. I'm seeing this several times a day where people are being asked to say they're not going to go for a mortgage, and that's the only way they win out a bid. So we'll talk a little bit more about the dangers of that a little bit later on. So there are a couple ways you can do it. Within my firm at Guaranteed Rate, you can apply online. It's as simple as clicking apply online, and you can put your information into the system. Personally, I think it should be a combination of two things. Conversation with someone first and walk them through the process. Ask the pertinent questions that an online application will never ask you. It will ask you where you work and how long you've worked there. It will ask you your salary. It will ask you to give us approval to run your credit. But it can't ask you, where is the down payment coming from? Is some of this a gift? And if so, who is the gift giver? There's some nuances that only a conversation can get to the bottom of. But after I speak with someone, it is convenient for you to have time, whether it be after your work day or over the weekend, to plug in the information and get an automated response. Because all of our underwriting now, whether you go to a Wells Fargo, a Chase, a Guaranteed Rate, or any other of your local savings and loan, everything has become automated. So when you put in information, someone's going to hit a button that has, I don't know if you can see item number 3, it says Instant Approval with Freddie Mac's AUS. AUS is the acronym for Automated Underwriting System. And every lender around the country is on this AUS system. And so by putting your information into the system, if your information is accurate, it will provide you a pre-approval letter based on your information. That's pretty accurate as long as the documentation you provide afterwards supports the information you gave the system. And that is a big piece of this underwriting process. People sometimes wonder, if I have a pre-approval letter, I've gone online, I've gotten an okay, what are you then doing with my file for the next 60 days that it takes to get me to the closing table? And here's the piece that we weren't doing many years ago. We weren't actually, and I'm not speaking for me personally because I've never been I don't believe the mortgage industry was looking closely at the paperwork that was being provided. I can speak for myself. I've bought a few properties, and it happened to have been during the excited real estate market where underwriting was so free-flowing, if you will. And I owned a home out in Long Island, and I was looking to buy another property simultaneously in New York City. And it took my office all of 2 days to get me a commitment letter for a pretty large amount of money. Even I was shocked at the time how easy it was to get a loan. So those days are gone. So if you look here at 5 steps to a perfect loan, it starts with really good paperwork. At a minimum, 2 months pay stubs, 2 months bank statements or asset statements, 2 years federal tax returns, and the contact person at your HR department. Now, one of the things that all the banks are doing now is a lot of compliance and audit review and quality control. These are all the buzzwords you're going to hear when you're talking to your loan officer saying, what's taking so long? You're going to hear, oh, it's an audit, it's quality control. And, these are words that we're using, but it is actually happening. We are reaching out to the IRS, for example, to get a copy of the tax returns you filed. Now, borrowers say, why? I've already given you a copy of my tax returns that I filed. And that's true. But what we are now required to do on every file is reach out to the IRS and confirm that the copy we're looking at is the same copy you filed. Now, for those of us on this call, it doesn't even occur to you as to why that would be, but that's because during the heyday of frenetic lending, let's call it, I think people might have gotten a little aggressive and provided tax returns before they filed them, and maybe they made changes to those returns when they finally did file them. Things like that. But basically, there was fraud going on during those years that the government and the mortgage industry is now trying to rectify. So everything you provide will be checked and rechecked. Everything you deposit in the bank during the period of time before you sign the contract, during your application, up until the day you close, will be looked at. So while you're doing a pre-approval, you haven't actually signed a contract, but the 2 months prior to signing a contract are important as well, because we're going to go back in time 2 months. So if, for example, you make on an average of $7,000 a month, and your paychecks are regular and they're the same amount every month, any deposit in addition to that pay stub is going to be questioned. If you got a refund from your insurance company, if your friend was in town and you lent them money and they gave it back to you before they left and you deposited $500 in your account that isn't the normal deposit you make, the bank is going to ask you for proof of the deposit. There's nothing wrong with it, but be prepared to provide a copy of the check and a copy of the deposit slip. If you get a gift from a family member before you buy the house, make sure you make a copy of that check and make sure you have access to the source of where that money came from. Now, just on a side, that is not necessarily because they're looking for you to qualify those assets. This is more about our Patriot Act. The Patriot Act actually has been around a very long time, but it's more and more involved in the mortgage industry now. Any money that is deposited in the window of time I just mentioned, prior to signing during the contract, prior to closing, they actually want to make sure legal, that and these are the 3 categories they're looking for. And I know this might sound again crazy to those of us on this call. They're looking for drug smuggling, money laundering, and terrorism. So don't be offended with the amount of questioning that an underwriter might do when you apply for a mortgage. It is to protect us, and it is something we have to abide by because it's the law. So one of the things about the pre-approval letter that's important is that now it says before signing the contract, but I would bet most real estate brokers want this letter before they'll even let you make a bid, is they want to know that you have spoken to a mortgage person and your documents have been looked at. I can tell you the majority of the real estate brokers I work with won't even take someone out to show them a property, to not even show you property before you've been pre-approved for your mortgage. In the old days, it was the other way around. You spent weeks and weeks looking for property, found something you liked, made an offer, it got accepted, and then you called your mortgage professional. It's quite the opposite now. You must make that phone call first. So after you sign the contract, so let's assume you've won this bid and they're willing to let you go for a mortgage, you are typically going to get 30 to 45 days to get your mortgage. Now, what we're finding again, and this is very specific to the market we're in now, is 30 days is actually not quite enough. You might not have a say in it. If you are buying a property that had a lot of competition, there were a lot of bidders, there were a lot of people who wanted the property, then you might just have to agree to getting your mortgage in just 30 days. And that's okay, especially if you started early. So if you give a loan officer your pay stubs and W-2s and tax returns and everything you can except for that executed contract and the 4 things listed here, you could be 2 weeks ahead of your competition by having your file already in process. Then 30 days probably is reasonable, but I would suggest that if you could get 45 days to get the mortgage, that would be a little less stressful for you, your attorney, your real estate broker, and certainly your mortgage professional. So if you've done all your pre-approval process early enough, then the only thing you need once you sign the contract is that contract, proof that you've given the down payment, and some updated income and asset documentation. And then the file will be further along the track. Okay, so a conditional approval is what you're going to get first, meaning it's going to say, congratulations again, we are now committing to lending you money, but there's always going to be a few items needed even then. So perhaps it's a verification from your CPA if you own your own business. Perhaps it's updating documents. Perhaps some things were discovered in underwriting that you didn't even think was going to come up because you just didn't think of it. I'm working on a loan right now where a borrower is buying the property without her husband for credit purposes. She's buying without him, but because they file their taxes jointly, his stuff shows up in her world. So we actually ask, could you please explain X, Y, and Z on your tax return? Well, it has nothing to do with her, but we still have to explain it. That just wasn't thought of prior to her commitment letter. So now we're working on that part now. It is very rare you get a completely clean approval letter that doesn't have additional items. The banks want to protect themselves. They want to make sure that by the time you get to the closing, every T has been crossed, every I has been dotted, and then some. To be perfectly candid, you're going to feel at some point in this process like, because it is some work, and I will tell you that at the end of it you feel very relieved, but it could feel exhausting. And so I prepare you now for the fact that it's a lot of work, but the end result of owning your own home obviously is worth it. So once you have your commitment letter and you're all set, you'll confirm your closing date, and the bank will get you to the closing table. Here's a summary of everything the bank does. The bank does a lot. Your attorney, especially in New York, does a lot more than in most states. There are lots of attorneys involved in the New York process. Your attorney, seller's attorney, sometimes the co-op attorney, and the bank's attorney. So a lot of attorneys in the middle of this. So let's talk about credit. We're going to talk about the purpose of credit, what to look for, how these scores get calculated, how to get a copy of your credit report, and how to repair your credit. So the purpose is obviously the lender wants to see what debts you have, how you pay your bills, and they assess the risk involved in lending you money based on your credit. Now, I'll tell you this, I discovered that even when I was applying for different types of insurance, they run your credit, and it's important to see your payment history. I was very surprised to find out that my homeowner's insurance and my car insurance is affected by my history of payment, because they determined, and this is your actuaries who run numbers on everything, they determined that people who pay their bills on time and don't have a lot of debt typically file less claims. That's what I was told by my insurance broker. So just an interesting thing to note, that having good credit isn't just about getting a mortgage. So let's say you don't have a lot of credit, which is many of us. We graduate school and we didn't have any credit before, and we're lucky to be in debt. But believe it or not being in debt and having no credit is almost with blemishes. So here's a few ideas on how to establish credit. Apply for a credit card with a reasonable limit. There are cards out there that are actually secured, meaning you send them $500, they put it almost in a bank account for you, and now you have a credit card with a $500 limit on it. So buy something for $100 and pay it back. Do it over time, because it's not just having credit, it's the ability to use it and pay it back that the lenders want to see. They want a minimum of 4 trade lines. A trade line is not your phone or your rent. It is a credit card, a car loan, a student loan, a mortgage, and they want to see a minimum of 12 months activity. So for those of you who just don't have established credit yet and are thinking about buying property, now is the time to establish your credit. Okay, so on the credit report is all your information, date of birth, where you work, all the accounts you have open, if you've had a bankruptcy, any liens, any judgments, and every time your credit is run. And this is an interesting piece because inquiries come from all sorts of places. You know, when you go to switch your phone, your cell phone from AT&T to Verizon, Verizon's running your credit report. When you apply for auto insurance, when you apply for other things, when someone's running your credit, it will appear as an inquiry on your credit report. So I'm not suggesting that you don't go out and do these things because we have to live our lives and we have to get credit and we have to have cell phones and all that good stuff. But if you're going to get a mortgage in the next 90 days, you want to limit the amount of increase. So this would not be the time to go to Macy's and apply for that credit card because they're giving you 10% off your first purchase. This is not the time to have your credit run on a regular basis. The 90 days for applying for your mortgage. Now, applying for your mortgage, and you are welcome to and actually recommended to shop around for your mortgage. But I would not have you have 5 different mortgage companies and or banks run your credit. So you want to work with someone who tells you from the beginning, I will run your credit and I will send you a copy of the report. Because now once you have the report in your hand, you can shop around with that report. And you don't need to have every lender running your credit report. Anybody who insists during the pre-approval process that they have to run your credit again, I'd be wary of, because it's not actually necessary until you apply with them. And then of course, you do need to have them run your credit report. So credit scores are very interesting. They range from 300 to 850. I can honestly say I've never seen anything in the 300 range. Unfortunately, I have seen credit scores below 500, but typically we do see from 580 and above. And of course, the higher is better. Again, lenders see this as a way to predict your future payment on their mortgage. And that's all the lender cares about is that you pay your mortgage. Everything else goes away after the closing. They underwrite your income and assets and all these things to determine the possibility, feasibility, and actuarial numbers as to whether you are going to pay your mortgage. Because what they don't want is to have a loan after the fact where the borrower isn't paying. So any score over 740 is considered A+. So 740 versus 780 versus 790, I don't think there's that much benefit there. However, there is a slight difference between being 720 to 740, and we definitely see a difference when it's below 700. And the difference being perhaps your interest rate, perhaps loans available to you. Okay, so make up your credit score. Payment history, meaning whether you pay on time, how much you owe. Now, it's not just as simple as do you owe $1,000 or do you owe $10,000, but it's how much you owe based on how much you have available to borrow. So if you have a credit card that allows you to borrow up to $10,000 and you've borrowed $9,900, that is considered a negative because you've almost maxed out your card. So we like to keep the relationship between available debt and used debt below 50%. Now, I am not a credit repair expert. Savvy Ladies knows several other companies that do that for a living, and some of them are really, really good at it. And I can always connect you to people who do that for a living. But these are the 5 factors that affect your score. So the third one is how long you've had credit. We talked about that. Over 12 months is better. Over 24 months is even better. How much new credit you just opened. They determine that if you are out there getting new credit all at the same time and applying for a mortgage, there might be a little bit of a concern that you are going to overextend yourself. And the type of credit, installment loans, student loans, mortgage loans, help your credit score go higher than Macy's, Bloomingdale's store cards. You can get your credit report from any one of these 3 repositories or credit bureaus. You can also, as I said, if you apply with someone or get pre-approved with a mortgage lender, they should provide you a copy of it. There are 4 reasons, we kind of touched on them, that affect your credit score. If it's on the lower side, it's going to be the amount of accounts you have delinquent, how much credit you have outstanding. So again, if you're maxed out, it's going to bring your score down, and how many accounts you have with balances. All these things are within your control. Obviously, you can't change if you missed a payment, but you certainly can pay down debt, have the ability to, and not close accounts, but down balances so less accounts have debt on them. Some cautions. A lot of agencies out there mail out things, call you on the phone, and offer debt settlement or debt management plans. These hurt your credit for at least 2 years, especially for a mortgage. The second one I mentioned, don't let too many people run your credit. Get pre-approved one place and then get a copy of that credit report. Just know that prior to closing, we're going to run your credit again. It will not be considered a credit inquiry, nor will it affect your FICO score. But let's say you apply for a mortgage on May 1st, and we process your file through May, through June, and now you're going to close July 4th. Well, July 5th, let's say. On July 3rd, they're going to do what they call a soft pull and see if you've gotten any new debt. So don't buy your furniture before the closing. Not if you have issues with debt. Not if you are up against the max you should be at. So these are things that your mortgage loan officer should be walking you through when you apply. If you have plenty of room and your income supports the mortgage and has room for more debt, sure, go out and buy that couch. But if your numbers are what we call tight, your income to debt is high, your debt to income is high, then we want you to be very careful not to do anything prior to closing. Airport credit, you can have things corrected that are incorrect. You can dispute things that are incorrect. You can update personal history, but derogatory items do stay on your credit report. They're just not as relevant as time goes on. So I think one of the things out there is after 7 years, a bankruptcy, for example, falls off your credit report. It doesn't fall off per se. It just becomes less relevant, and the underwriter doesn't care anymore after 7. It will still be there. It's a public record. There are consumer credit counseling places, and as I mentioned, there are also some for-profit organizations that repair credit. So I want to move on to talk about condos, because condos are one of the prevalent products and properties that people are buying, not just in New York, around the country. We at Guaranteed Rate have a condo department. So it's an interesting thing, and I'm going to throw co-ops into the mix here as well, because we do have a lot of New York listeners. There's underwriting you as a credit risk, as checking your income, checking your assets, and then there's actually underwriting the property you're buying. When you buy a single family house, this is not a factor. As long as the house is in good shape and the appraiser tells us it's worth what you're paying for, they're not going into the house to determine whether the carpet is a good color or it's a good quality. However, when you buy a condo or a co-op, the lender wants to know that the condominium or co-op has good, healthy financials and meets the requirements of Fannie Mae and Freddie Mac. And if it doesn't, then we have to move on to some other lenders that are not so specific about what they're looking for. Typically, it takes us 2 days to review condos. With what's going on in the industry right now, I would give extra time for everything. So if you are looking at a condominium and you want us to check and see if the condominium qualifies, I would say not 2 days. Let's give it 4 days to review a condominium. So condo loans are a very large portion of certainly the business we do here at Guaranteed Rate, and this is a national number. Guaranteed Rate is across the country, so almost 25% of our loans are condominium loans, and I would bet you if they gave me the number for New York City or the tri-state area, it would be considerably higher. Common problems with condominiums: litigation. They're based on the structure. Maybe the original developer, maybe the unit owners are having a squabble over something that happened with the building. Whatever that is, whatever that litigation is, the hope is that it's covered by the building's insurance. As you can see, an issue becomes an issue when the lawsuit is not covered by insurance. Again, the lender is always looking to protect themselves. This is the truth be told, is that in the ultimate foreclosure, if you stop paying, the lender wants to make sure they now have a marketable property. I know it sounds harsh, and it would be nice to think that the lenders are looking out for your best interests, but at the end of the day, the lender wants to make sure that the building is healthy if they have to take the property back. And that's unfortunately the truth. Investor concentration talks about how many of the units are owned and occupied by the actual owner. So investor concentration has gotten to be a sensitive point because we have a lot of investors, a lot of foreign investors, a lot of people buying properties to rent them out. And too many of those in a building make a lender unhappy. Units that have less than a certain amount of units are also looked at. And each lender, this is a part that's interesting, each lender has their maximum that they want to lend in any one building. Another thing we look at, which is important for you as a buyer, is what the budget looks like on the building. I can tell you that I am on the board of a very large condominium, and I'm very excited to say tonight is our annual unit owners meeting where we're going to go over our budget for next year. And it's important that the building takes in enough income to cover the expenses of the building. So these are all things I want to let you know are not things you as a buyer are going to analyze yourself. These are things hopefully your real estate broker is privy to. For sure, you're going to research for you and advise you, and your mortgage loan officer is going to give you some insight as well. If you're looking at new construction, on this page it says pre-sale. It's important that a certain number of units are actually bought before a lender wants to lend in there. Now, this is a little bit of a contraindicator. How do you buy in a building if you want to buy a new building and no one else has closed yet? How do you get anyone in if each person needs the other person to move in first? So we work around that. We actually line up the closings to happen at the same time. We let our all cash buyers close first, and we set it up that way as a domino effect, if you will. We worked on a project in Brooklyn recently where it was new construction, and we coordinated with the developer and the on-site sales brokers to get the closings done for those people paying all cash first, so that our mortgage people could come in afterwards once a certain percentage of the units had closed. And the last one I think that's worth pointing out is when any single entity owns more than 10% of the building. We see that a lot in New York City, again, because buildings that used to be rental buildings that are now condo buildings have some people who didn't buy their apartment. Maybe you even live in one of these buildings now. It's a rent stabilized building. You were a renter, you are a renter, and the building went condo, and that's fantastic. But you're not mandated to buy your unit. So if the sponsor is still your landlord and there's too many of those in your building, and again, conveniently, I live in one of those buildings, it becomes a difficult building to finance. So all things to look out for when you're buying condominiums. We have a lot of information through Guaranteed Rate that we can send out, demystifying the mortgage process, explaining appraisals and other items like that. I want to touch real briefly on co-ops because it does add one more layer that this presentation doesn't necessarily have a slide for. So for those of you who are looking at co-ops, we have one more piece to the puzzle, and that's a co-op board. And so you go through the process of bidding on an apartment, you get accepted to buy it, you go through your mortgage process, you get approved for the mortgage, and let's say we've even approved the co-op itself. Now you get to sit in front of a board who decides whether you meet their requirements to buy. So just to prepare you for the co-op world, you can go through the whole mortgage process, sign a contract, put a down payment down, and sit in front of the board and be turned down. It is still one of the rare few entities out there that doesn't have to even tell you why they turned you down. It might not have anything to do with your assets, your income, your credit. It could be they didn't like your dog, or they just, I actually heard, I think it was, I'm not sure what famous rock star it was, who had more money than God, and they got turned down by the board. In that case, the presumption was they didn't want the paparazzi around the building. So they chose not to accept this high income net worth person because they didn't want the fanfare. In that scenario, I'm not an attorney, but I will tell you that to my experience, you will get your down payment back, so you would not lose any money there, but you will have spent the time and money to get a mortgage, and that money you would not get back. So you'd be out a few $100s for an appraisal and perhaps some money to the managing agent. So I just wanted to briefly touch on co-ops because it is such a specific product, and here in New York it's such a big thing. Anybody who's interested in buying a co-op, I'm happy to talk separately with you, or do a separate webinar one day about co-ops in general. So my contact information is here. Please don't feel obligated to get your mortgage through me, but you can use me as a resource, whether it be to find attorneys, brokers, just run scenarios by me, and ask me any questions that you might have. And now I'm going to open it up to questions if we still have time.
Great. Thanks, Jackie. That was so helpful. Yeah, so let's move on to questions. The first one that came in is it true that there is a 30-day window when shopping for a mortgage where the impact of inquiries is factored in when you're shopping for a mortgage?
That's what I'm told. And so I'm going to say, yes, it's true. However, I still would be cautious not to overrun my credit because it's still suggested to not have more than 3 people run your credit in that window of time.
Okay, great. And our next question is, do mortgage rates differ from state to state?
Slightly, and that is more a factor of the fees that the state charges the lender. So just to give you an example, the difference between New Jersey and New York, we have mortgage tax in New York. There's no mortgage tax in New Jersey. Other things are more expensive there, perhaps the property taxes. But this mortgage tax is something that you as a consumer pay when you buy property, 1 to 4 family homes, condos, anything other than co-op. And the lender pays a quarter of a point as well. And so lenders build that into the rate in New York. So if you're comparing New York and New Jersey, you might see an 1/8 of a point difference in interest rates. The other thing that affects the interest rates by geography is the loan limits in your county, and then therefore the loan limits can affect the rate.
Okay, thanks. And another question that came in is, are there differences when getting a mortgage for a short sale?
Well, out on ours, it's more stressful because you are applying the mortgage with, but you're buying it from a bank. That bank is much less responsive than a typical seller. They probably have a lot of competition, and I find sometimes in a short sale they don't give you enough reasonable amount of time to get the mortgage. So you need to be prepared, perhaps if it's possible, to pay all cash, maybe get a gift from a family member, and refinance it after the fact. Because the way a short sale is set up, it's interesting. You have to get an accepted offer and sign a contract, and then they go to the bank that's holding the property to get their approval on that short sale price. So you do a lot of work to then find out whether they're accepting the price. Even if, so it's got a lot more layers. Getting the loan itself is not harder. It's maneuvering the other side that you have to have a really good, savvy attorney, forgive me, who plays in that world, who does short sale transactions. I think that's very important.
Okay, and I think we have time for another question, which is, if I'm over 65 years old and buying a home for the first time, can I get a mortgage if I can prove regular income?
Absolutely. We do not discriminate against age, sex, race, religion, anything. You can get a 30-year mortgage at 80 years old. I will tell you, though, what being 65 does get you as an added benefit is you can actually purchase a property with a reverse mortgage and have no monthly payment. That is a complete webinar onto itself, the nuances of a reverse mortgage. And that is a huge benefit for the seniors who want to buy property.
Mm-hmm. Okay. Well, thanks again, Jackie, for such a great presentation.